Assalamualaikum Dr. Umar. We are from class E to L group 1. As today, our group will present the result of our financial analysis for Apollo Food Holdings Berhad. But before that, let me introduce myself. I am Sarah Nadia binti Rudi Kurniawan. Let us go through what is Apollo. It is actually the trademark for Apollo. Apollo! Like that. So back to our presentation. The Apollo Food Industry Company, headquartered in Malaysia, is a chocolate confectionery and layer cake manufacturer. Their product includes compound chocolate confectionery item. The Apollo Company is the most successful company in Malaysia, especially for the productions of chocolate confectionery items and layer cake. These cakes are also very popular in the markets, in the international market, especially in Singapore, Indonesia, Thailand, China, Hong Kong, Taiwan, Japan and India, where Apollo export their product in the large quantity to those countries. By utilizing the advancement of technology, the Apollo's primary objective is to consistently to satisfy what their customer wants and what their customer needs. So that's all about the Apollo. So let us moving on to the financial analysis and non-financial analysis of Apollo. Right, in this slide, we can see it shows the statement of profit or loss for Apollo Food Holdings. So for the SOPOL, we can acronym it as SOPOL. So for the SOPOL, we use for horizontal analysis and vertical analysis. So for this one, we focus on horizontal analysis first, and then for the next slide, we will discuss on the vertical analysis. So for horizontal analysis, we use 2019 as our base. So remember 2019 as our base. So when we talk, when the questions highlight that 2019 is our base, is using for the base, so we need to divide any number of year, any amount of year to the amount number of our base, which is 2019. So we go first on the revenue. As we can see in 2019, the amount is 188,835,825, and we divide the number by the amount of our base 2019, which we divide by the same amount, we get 100%. So we're moving on to the 2020. We divide the amount of 2020, 174,394,531. We divide by our base amount 2019, which is 188,835,828, and we will get 92.64%. So therefore, this is how we calculate the rest of the statement of profit or loss for the horizontal analysis. We use 2019 amount as our base. Okay, so let's moving on to the next slide. Alright, for the horizontal analysis, we focus on the three factors, which is revenue, other income, and administrative. So we will go first on the revenue. The Apollo rapidly increased their revenue from 2020, 92.64% to 2021, 100.82%, which we can conclude that the company increased their sales price despite of the COVID-19 stroke in Malaysia and restrictions of MCO imposed by our governments. So next, other income. The other income at first decreased from 2019, which is 100%, to 2020, 86.43%. So we can see the trend is decreased, but from 2020 to 2021, the other income increased rapidly from 86.43% 2020. You can see it increased to 155.81% in 2021. So this is, we conclude that the contribute by the increasing of interest income that Apollo received on that year. So we will go for the administrative. The administrative expenses increased by 8.05% in 2020 due to the higher employee salary, due to the impairment loss on receivable, due to the maintenance expenses, and lastly provisions for restoration costs. So for the 2021, we can see the ratio also increased by 14.95% in 2001 due to the impairment of investment in an associate and acquired a huge of employees intake on that year. So that's all for the horizontal analysis. We will go to the vertical analysis.
Now I will be presenting on vertical analysis. There are two elements that I will highlight based on the vertical analysis, which are cost of sales and profit for the financial year. The cost of sales drops in 2020 due to COVID-19 pandemic that affected the operation of the company, which led to reduced demand, while in 2021 it increases, which might be due to inflation and rising input costs as the economy began to recover. On the other hand, the profit for the financial year in 2020 decreased. It might be caused by economic downturn and lockdown measures contributed, which led to a drop in company sales, which consequently impacted the company's profit. In 2021, the profit increases. However, based on the annual report, it is mainly due to reversal of impairment loss on PPE and fair value gain on other investments. Asset test ratios determines if a corporation has enough cash on hand to cover its immediate liabilities. Greater asset test ratio implies greater ability to satisfy short-term obligations without relying on inventory sales. In 2020, the asset test ratio increased due to decrease in customers' demand caused by pandemic. Meanwhile, in 2021, it decreases might be caused by decreased customer spending, which causes low inventory turnover. The longer the product remain on the shelves, the higher the inventory levels would be, which therefore lowered the acid test ratio. We have made some calculation for relevant ratios to analyze the performance of Apollo company. Now, we will first look into the liquidity ratio. The first one is current ratio. It assesses a company's capacity to settle short-term debts or those that are due within a year. A greater current ratio shows stronger liquidity position. Apollo's current ratio increases in 2020, which shows better ability to meet short-term obligations. As the pandemic may have disrupted supply chains and altered consumer behavior, the company may have changed their inventory management strategies, reducing stocks to reduce the danger of excess inventory, which has benefited the current ratio. Meanwhile, in 2021, it dropped because of economic impact of the pandemic. The economic impact led to increase in short-term liabilities such as trade payables and major increase in current tax liabilities, which causes current ratio to decrease. Next, inventory turnover assesses how well a company maintains its inventory. Higher inventory turnover ratio suggests more efficient inventory management since they imply faster sales. In 2020, the inventory turnover fell, which suggests companies' inventory turnover has slowed due to reduce in customer purchases during pandemic. It increases in 2021 as consumer demand may have been rebounded as economies begin to recover from the first effect of the pandemic.
The debt to asset ratio for the years 2021, 2020, and 2019 are 9.2%, 7.69%, and 7.98% respectively. The debt to asset ratio at Apollo remains relatively constant, increasing slightly to 9.2% in 2021. This low ratio is appreciated by creditors as Apollo has more equity funding than debt financing, providing a margin of safety. The debt to equity ratios for the year 2021, 2020, and 2019 are 10.14%, 8.33%, and 8.67% respectively. Apollo Food Holdings Berhad's debt to equity ratio remains relatively constant, increasing slightly to 10.14% in 2021. This indicates a 1.81% increase in payables, but the ratio remains favorable due to its reliance on share capital and earnings. Lower debt to equity ratios are preferred by lenders and investors as they reduce loan default risk and insolvency risk. The equity to asset ratio for the years 2021, 2020, and 2019 are 90.8%, 92.31%, and 92.02% respectively. The equity to asset ratio increased from 92.02% in 2019 to 92.31% in 2020, but decreased slightly to 90.8% in 2021. This indicates lower financing and debt payment costs, potentially attracting more investors. The high ratio suggests Apollo Food Holdings Berhad is a safe company offering security to creditors. Next, we move on to the profitability ratio. The first ratio is the net profit margin. The net profit margin for the years 2021, 2020, and 2019 are 9.2%, 8.14%, and 9.23% respectively. Apollo Food Holdings Berhad's net profit margin decreased from 9.23 in 2019 to 8.14% in 2020, mainly due to high expenses. However, it increased to 9.2% in 2021, generating RM 0.09 in net income for every RM1 sales produced. This margin is below the 10% average, impacting investors' investment and determining the company's profitability and cost control. Next, we move on to the gross profit margin. The gross profit margin for the years of 2021, 2020, and 2019 are 12.23%, 11.4%, and 12.5% respectively. Apollo's gross profit margin decreased from 12.5% in 2019 to 11.4% in 2020, resulting in expenses of RM 0.88 and RM 0.89 for 2019 and 2020 respectively. In 2021, it grew to 12.23%, but a desirable ratio of 50% and 70% is still not favorable. Apollo's poor performance will take time for them to break even and start making profits. The last profitability ratio that I will be sharing is the return on assets. The return on assets for the year of 2021, 2020, and 2019 are 6.65%, 5.4%, and 6.54% respectively. Apollo Food Holdings Berhad's return on asset decreased from 6.54% in 2019 to 5.4% in 2020, resulting in net profit RM 0.07 and RM 0.05 for each asset invested. However, the return increased to 6.65% in 2021, proving Apollo's ability to turn assets into earning.
On dividend per share. Dividend per share is a financial metric that represents the amount of money a company distributes to its shareholder in the form of dividends for each outstanding share of the common stock. Dividend per share are an important measure for investor as it indicates the amount of cash flow that they expect to receive for each share they own. Based on the table above, in 2019, Apollo had a dividend per share of RM 20 cents. Dividend per share remains unchanged at 20% in 2020 also. In 2021, dividend per share increased to RM 30 cents, indicates a change of dividend policy. However, factors such as industry trend, overall market condition, investor sentiments, and economic factor might have influenced the company dividend decision. During the pandemic period, 2020 and 2021, the impact of pandemic Apollo financial performance has reduced the revenues, increased the costs, and uncertainties might have affected the company ability to increase dividend. So, let's move on to the market evaluation ratio, earning per share. The earning per share is a metric for determining a company value based on the net profit after deducting the preferred dividend for each share of the stock in the company. The performance of Apollo in 2020 fell into RM 80 cents per share due to the fact that the company net income fell by RM 3 millions, even though the weighted average of number of shares increased by RM 80 million. In 2021, Apollo earning per share increased by RM 4 cents, which entirely due to the Apollo increase in net income from 40 million to 17 million ringgit Malaysia. Apollo weighted average remains constant for these 3 years because it is average that is used on a regular basis. The last one is dividend payout ratio. Dividend payout ratio measures the percentage of net income that is distributed to the shareholder in the form of dividends. Dividend payout ratio of 30% to 50% is considered healthy, while anything over 50% could be unsustainable. The lower the ratio, prove a better performance, especially will attract more investors to invest in Apollo. Throughout 3 years, Apollo showed an upward trend since the ratio increased by 20% in 2020 and continue to increase to 25% and an extra of 5% in the previous year in 2021. Even so, both ratio in 2021 and 2020 are above hundreds, and these are very risky for Apollo since the company did not retain any profit of the company in the reserve account. In 2019, the global economy has generally stable, and factors such as industry trend, overall market condition, and others has influenced the company payout ratio. And during pandemic, the impact of financial performance has reduced the revenue and increased expenses, and liquidity constraints might have affect the company ability to maintain or increase dividend payout. So, let's move on to the cash flow analysis. The first one is operating cash flow to total debt. The cash flow to debt ratio is a coverage ratio. It can be used to determine how long Apollo would need to repay its debt if all its cash flow was devoted to paying it, as well as showing Apollo overall financial health. It is include an overview and overall finance. In 2019, 2020, and 2021, the company ratio are greater than 1. Demonstrate it a sufficient cash flow and liquidity is meets its debt obligation. Apollo is showing signs of improved cash flow for the operating activities in the future, with an increase in operating cash flow between 2019 and 2020, while the ratio exceeds in 2021. Apollo performance are still worse than it was in previous year, as the company incurred more debt in 2021. So the next one is operating cash flow per share. The operating cash flow per share defines the fund flow of per common share outstanding in the company. Apollo will able to use this ratio for making wiser decision about dividend payment and capital expenditure. And operating cash flow that is strong is a sign that the company is doing well financially. In 2019 and 2020, Apollo will give its shareholder RM 30 cents for each share held in the company. As a result, in the deficit in Apollo cash flow, The company is paying dividends to its shareholder at a lower rates than its last year. This demonstrates Apollo poor performance when it's come to fund flowing to shareholder. In the end, ratio indicates an affordable ratio for the company as a whole, since Apollo decreased its operating cash flow and gave the lowest amount of cash per share within these 3 years. So the last one, operating cash flow to the net income. The cash flow to the net income measure the ability of the business to generate cash in the form of operation and ideally should be greater than 1. It's well known that many investors and analysts prefer to use operating cash flow as indicator of the company health. According to the ratio for the year 2019 to 2021, Apollo has indeed able to cover its current short-term liabilities and still has earning left over. In order to justify this, the ratio for each these years are greater than 1. For the year 2020, 2019 and 2021. Since Apollo has a large difference between operating cash flow and net income, it marks the company may be healthier than its net income suggests.
Yes sir, it's me again. So, right now we will discuss about the qualitative information from Chairman's statements, and I will focus on the strength of Apollo, which I am believe that there are a lot of development. There is a lot of strength in Apollo, but for today, I will just focus on 2 points, which are quality and strong brand value. So, we will go first on the quality. Apollo used the top quality of raw materials and the top quality of packaging material to produce its product. So this is the first one. The second one, the Apollo used the best wafer and layer cake manufacturing machinery, the machine that they import from the Europe. And the third one, the Apollo are constantly upgrade and improve to remain competitive, and also they upgrade to increase the customer satisfactions and to maintain a high level of quality. That's all for the quality. And other than that, the Apollo also remain their strong brand value as one of their strengths, which are Apollo enjoy a strong brand image and positive reputations on the both market, which are for the Malaysian market and international market. But why this happened? This happened because Apollo has become a family-friendly business by offering a wafer layer cake as a nutritious nibbles. And as for our informations, Apollo also is a product that serves as a between meal or after school refreshment for children. That's all for strength. I will pass the floor to Farhin to continue our presentations on the weaknesses of the weaknesses that have in Apollo.
There are 2 weaknesses spotted in the company. The company has a dependency on non-recurring factors. The increase in profit in 2021 was mainly due to the reversal of impairment loss on PPE and fair value gain on other investments. These 2 events are non-recurring events and are not sustainable in the long term. It shows that company is unable to consistently generate profit through its core operation. If the events do not occur, it could affect the company's profit significantly. Second weakness is the dependency on local and overseas customers. COVID-19 pandemic has influenced the operation and business of the group. It affects the demand of local and overseas customers. The movement control order caused significant disruptions and changes in customer demand, which resulted in reduced consumer spending. The company may diversify its customer base, explore new markets, or consider product diversification to reduce its reliance on specific customer segments or locations. Last analysis would be Admiral's Z-score analysis, which is used to assess the financial health and bankruptcy risk of a company.
Apollo Food Holdings Berhad has a Z-score of average 2.6 for 3 years, which falls between the range of 1.8 to 3.
A score between 1.8 to 3 suggests that the company is in the gray area and has a moderate chance of going bankrupt. Company may have some financial concerns and should be monitored closely. It is not an immediate indication of bankruptcy but suggests that the company's financial health is relatively weaker. It may be challenging for Apollo company to obtain credit from lenders or creditors. Apollo needs to consider financial restructuring options to improve its financial position.
So, the last part is the conclusion. In conclusion, Apollo demonstrates strong profitability, but its liquidity position presents some challenges. The asset test ratio indicates potential liquidity issues that need to be addressed. To ensure both high profit and robust liquidity position, Apollo should prioritize improving their current assets and current liabilities, especially increasing and enhancing their cash and cash equivalents would boost their ability to meet short-term obligation. This would stabilize their liquidity performance and reflect the current and asset test ratio. Thus, a well-defined plan and strategy along with improved cash flow management are crucial for the company in short-term prospect and future probability. It is essential for Apollo to focus on these critical areas for their financial statement, particularly liquidity. to avoid the risk of bankruptcy. By taking immediate action and implementing solid measures, Apollo can secure their success and expand their activity to the other countries. Thank you. That's all.